Bloomberg Audio Studios.
Podcasts, radio, news.
You're listening to Bloomberg Businessweek with Massar and Tim Stenovec on Bloomberg Radio.
All right, from New York Community Bank to HPE we go.
Yeah, shares down about 4.2% in the after hours. This after the company reduced its outlook for sales growth and profit in the current fiscal year, citing lower demand for networking products and a crunch in computer chip availability. We got with us Crawford Del Prete, president of IDC, and he caught up with the HP CEO right after the results. Crawford, good to have you with us, joining us from Massachusetts this afternoon. First of all, your thoughts on the quarter and on the company reducing its outlook for sales growth for the fiscal year. And also, what did you hear from Antonio Neri?
Yeah, absolutely. Carol, Tim, great to talk to you guys again. So when you look at HP, I think that the first thing you have to think about is that this isn't the old HPE that we've kind of known. This company has been going after the networking space and has really been succeeding in the networking space for a number of quarters. And if you look at where they were over the last, I think, 6 quarters, they were growing their networking business, which is primarily a company they bought a number of years ago called Aruba Networks, which is sort of campus networking and networking out at the edge of the network. That was growing in excess of 30%. And so, like we saw at Cisco, you've seen that we've pushed a lot of product out to customers, and customers have said, we're going to take a pause here. And so they've taken a pause, and HP saw, their networking business, what they call their intelligent edge business, which is the majority of the networking business, up about only 3%, which compares with the 30% kind of range. So, that's kind of one big part of the story here is that the intelligent edge has dropped down. The other part of the story is that obviously, from a total growth standpoint, the company didn't even deliver on the low end of their range. So they were down 14%. And that was fueled by what I would say was, weakness in sort of that core server space, which was down about 23% in terms of total revenue. And so what I heard from Antonio, understandably, is that they've taken a tremendous amount of cost out of this business. And so from a margin standpoint, I think that, from a defensive standpoint, they've made a lot of progress. And that's really what they did, was to hedge against the cyclical nature of the business. Also hedging against the cyclical nature of the business, and rightly so. They've seen 41% in their ARR growth. So people think of HP as a gear company, but really they've got a platform for them to sell as a service gear, as well as services around that gear. And that business continues to grow. And over time, as we have seen, we'll continue to see that deferred revenue accrue to HP's revenue stream. So, again, it was a mixed quarter, definitely a pause on the part of a core part of their business that had been fueling growth. And, I think that this is where they're playing a little bit of defense.
Yeah. You talking with Antonio Neri, the CEO, and I guess our folks did too, and saying that downward revision in terms of the outlook is due primarily to that slowdown in the networking market and a lack of availability of graphics processor units required to deliver high-powered servers. Telling all of those, we're talking about GPUs, right? And he did say it looks like should improve in the second half of the year. The networking market is poised to recover in fiscal 2025. He said, what was top of mind for you as you talked with him, Crawford, about
Yeah, so as I talked to him, top
know?
of mind for me is, thanks, Carol. So top of mind was, sort of why is it that, and when do we expect GPUs to get better? And what they've seen is a significant amount of bookings. I think they have, a significant amount of AI bookings in the quarter. I think they're going to be working down a set of AI bookings as they get, I think it was a number somewhere around 3 billion that they're going to be working down for customer commitments that they already have in place. And so, I think what you're seeing is similar to a lot of companies in that we are seeing a massive infrastructure upgrade within customer sets. And it's really about who can get availability who's got the scale. And I think that ended up being, one difficulty point for HP in the quarter, in that, the availability just isn't there. But I think that, we saw announcements from Intel, we've seen announcements from AMD. I think we're going to see a significant availability in the second half of the year. And that, I think, is going to fuel a sustained set of growth. And Antonio talked about that for the infrastructure space as we get into the later part of the year. And I think IDC's numbers reflect that. We expect the server and storage market to deliver somewhere between 6 to 8% growth this year. And that's going to be fueled on AI.
Well, that's exactly what I want to talk about, Crawford, was HPE's exposure to AI. And I'm wondering this from the perspective of, okay, we know that IT spend is going up this year. And I know there's a lot of talk of a lot of that spend going toward companies like NVIDIA, companies like Supermicro. To what extent is HPE a beneficiary of the run-up in AI?
Oh, they're a massive beneficiary, and they're a massive beneficiary. By the way, as are Dell and as is companies like Lenovo, other infrastructure companies. HPE is a little bit different, and they're different because of the bets that they've made around the network and the edge. So they are going to be able to provide devices that are going to be processing at the core, which is their core server business. And don't forget, these guys have a very, very large footprint in supercomputers, which is going to be another area of AI growth and AI investment going forward. As well, at the edge, where I think we're going to see more what they call inferencing at the edge, being able to process at the edge in order to make decisions very, very quickly on your data. They're going to do that through Aruba, and they're going to do that through an acquisition that they just made that they've announced, which is Juniper Networks. As well, they're going to be able to benefit from what I would say is the need for more ports because of AI, right? So as AI continues to proliferate, you're going to need to move more network, you need to move more data across the network, which means you're going to need more advanced switching technology. And that's where their Juniper acquisition is going to come in. So you need to think of it as opening up the interstate highway.
Right.
You need to open up the interstate highway, and HP is going to benefit from that as they close the Juniper deal from those three: core, edge, and network.
Hey, listen, real quickly, because Dell came out, its stock is taking off big time in the aftermarket. They reported better than expected sales, the topped estimates on AI server excitement. How do you contrast what we're hearing with Dell versus what we're kind of hearing kind of on the HPE side? And just got about 20 seconds.
Yep. So I think a couple of things. I think that Dell had probably better availability and was able to get better sell-through on GPUs, which, again, late-breaking news here. The other is Dell doesn't have the same level of exposure to the networking market, which is what we kind of just talked about. So Dell's able to really benefit, if they can get them, by selling these GPUs.
All right. Great stuff, as always. Crawford, thank you so much. Busy afternoon for you, and really appreciate you carving out some time for us. Crawford Del Prete, president of IDC, joining us from Massachusetts. Shares of HPE down about 3%. Dell is up 16% in the aftermarket.
There are a lot of people out there who worry about money. In fact, if you worry about money, you're not alone. A new study from Wells Fargo says that more than half of Americans, 56% in fact, say they always worry about money, even when they have enough.
Yeah, 2/3 of Americans have decreased their spending due to the economy. These are just a couple of the nuggets in the Wells Fargo Money Study. It's a new study out from the bank. And lucky for us, Michael Liersch is here. He's head of advice and planning at Wells Fargo, joining us here in our Bloomberg Interactive Broker studio. What?
Okay, is this just the human condition, that no matter how much money somebody has, they're going to be worried about money?
There's an element of that, but part of this is also the narrative out there
about
what money means. And you see it in social media, you see it in conversations, which is money might not be taking us as far as it used to. And so that's creating, actually in our study, it actually creates an extraordinary worry beyond what people said they worried about when they were younger.
Yeah.
We were just talking about this with our TV crew,
Yeah.
About the price of eating out for lunch or the price of getting a salad delivered.
Right,
It's
not
like
cheap.
sticker shock for a lot of people.
It is. It's kind of ridiculous. Or buying a pizza, and you're like spending $50. And you're like,
You give me such a hard time for hoarding snacks upstairs here, where they're so generous with their snacks here. Like you walk by my desk and it's just like it's a buffet of free food.
Snackapalooza.
Yeah.
No, but it's interesting what you say about kind of how we think about money and what it is. I've often thought about in a society where increasingly aren't handling cash, like, are we getting distorted that we just kind of, digitally doing everything, then all of a sudden we're like, oh my God, where did it all go? But anyway, tell us more of what you found out.
Well, there's a piece of that. I mean, we ask people what they do every week. And they said things like spend 9 hours scrolling social media and 3 hours a week looking at their money. So to your point, we are actually not looking at our money as much as we used to, because remember when we used to have like clips that would put our money in wads and we put them in our pocket, or we'd actually, to your point, take out the cash, get change. We'd have a piggy bank.
When I was a kid, my parents taught me how to balance a checkbook.
Yeah.
And like, if I didn't balance my checkbook at the end of the month,
did you get in trouble?
Yeah, I would get in trouble. And my parents would be like, okay, where did the money go?
So we asked teens actually about their anxieties related to money in the survey, and we do something called the Talk Aloud protocol, where we just have conversations like this.
Yeah.
And one of the teens said they didn't even know what a bank account was, and they wanted us to explain it to them. So you're spot on. You're right. It's not the typical thing these days.
Michael, I feel like in my whole career, there's a couple of things that we've always talked about: more women in executive suites, and diversity and the importance of that, and yet we're still struggling with some of this stuff. But the other thing is financial literacy and the importance of teaching kids at a younger generation. I feel like kids, I don't know whether it's grade school, whether it's middle school, but somewhere home economics is going to the wayside, but we need financial economics being taught in schools. We talk about it. Why aren't we doing it, and what the impact could be?
Well, what's important to think about is, where do teens and young people want to get the information? And we ask that question, and where they get it.
Yeah.
And they do get it from their parents. So that's where they want to, and that's where they actually get the information. So we can look to, let's say, third parties to give our kids that information, but really they're looking to their family units to provide information about money, information about saving and investing, what to do with it, what constitutes things that are aligned with your values versus misaligned. And teens want that information. And actually, they said they want it from their parents, but they're also looking to banks to provide the information too.
But don't you think about it? Like, we talk about, so if your parents aren't great managing money, then you pass on those bad habits. So I just wonder, how do you break kind of the chain?
I see a lot of stories about that.
Absolutely.
People are pretty open on social media, this stuff, with stuff like that, and also like how they break those habits, which is difficult.
Well, one of the toughest habits that teens said that they observe and they do themselves is lying about money. How much they spend, how much their house is worth. So adults admitted to doing it, but teens admitted to doing it even more than adults. So we can say, well, what's going on, to your point, behind the scenes? How do we get past it? And what people say is there's just not a lot of money conversations going on in their families at all. So it's still something we're reluctant to talk about for whatever reason.
It's also, I think, hard, like, as a parent of young kids, it's kind of a hard thing to talk about, because, like, for example, I'm out with, my son who's 5 and he wants a snack, and I'm like, no, you can't have a snack. Like, we can't buy a snack every time we leave the house.
Right.
And he's like, is it because you don't have any money? And I'm like, well, kind of. I mean, yes and no.
We have money.
One time he told me to go to the money store. He's like, can't you order some money so we have money?
Well, money does grow on trees, doesn't it?
Apparently it does. Hey, I
like the way he thinks.
We can learn a thing or two from young kids, right? You break this down into different categories. Mm-hmm. One of the categories you define is the young affluent.
Yes.
Who are the young affluent?
So when we think of young affluent, think of 20-somethings. And when you think of 20-somethings, think of human beings who have anywhere between $250,000 to $10 million in assets. So it's a broad range of young people who actually are earning a lot and saving and investing a lot. Maybe they own a home.
That's impressive.
And what was very impressive about them is they're the most likely to want to do things like plan, not delay their life because of money, but they want to be more and more intentional about it. So they seem to be one of the more optimistic and planful groups of any of the groups we talk to.
I am wondering, in terms of this survey, and Michael, you know it, you're over at Wells Fargo. We are constantly, whether it's government data points on consumers, how they're doing, how they're spending, whether we talk to CEOs, consumer-facing CEOs, we've done that a lot, certainly this earnings season. But I'm wondering what this survey helped you kind of say about the financial health of consumers or society right now.
Two things. One is that Americans are relentlessly optimistic. And so what the majority of our survey participants told us is they wanted to stop talking about problems. And so when you think of concepts like financial health, that's nice, but what they wanted is this solution. Less of an assessment, more, well, tell me how I should be thinking about money, what I should be doing. The second thing is they're very eager to do things like figure out how to stick with a saving and investing plan. It's not that they don't know that that's important. It's how do you stick with it? And they often think you have to do in big large chunks rather than little bite-sized chunks. They think bite-sized chunks don't matter. So we have to reframe that as, financial services professionals, little tiny changes actually lead to big, extraordinary outcomes over 2 or 3 years. And I'm sure you see it. Your child probably sees it if you put a couple quarters, if you were able to do that these days, in a piggy bank. We all remember this. A month, 2 months, 3 months later, you could buy a toy. These are the types of things we need to start re-engaging in.
Fortunately, lollipops at swim class are 25 cents still.
Yes.
So there are
swim
some
classes
lessons.
Too?
Swim classes are not. Swim classes, I'm not even going to get started on how expensive swim classes are. Hey, before you go, Michael, this is the first time that Wells Fargo has done this. So there's not this idea of comparing it to what's happened, what the research has said in previous years. But still, can you offer us any differences from earlier generations or how this thinking has changed?
Well, so the thinking has changed in terms of Americans not wanting to feel judged by others or by themselves about money anymore. And that's something that I think people were more willing to accept. I think social media has got us more aware that that's not a great behavior. And the second thing is they really want to set goals. And so we have a capability called LifeSync in our mobile app. And what it does is allows you to actually say, I want to manage credit and debt. I want to manage my spending. You can upload pictures to inspire you. So people want to be more inspired. And so that's where it's changing. People want to shift from pessimism, talking, let's say, badly about themselves or judgmentally about themselves and move toward optimistic ideas.
I think those apps and so on and so forth that kind of help you track your spending, kind of set your goals, can be really, really useful. I was just going to say there were a bunch of kids just outside our studio.
Is there like
I didn't know if that was part of your survey or
maybe I know them and I don't realize it.
Or maybe they have something to add.
Our healthcare team leader, Cynthia Coons, and her kids.
A couple of juice boxes there. It was really adorable. This was fun. Very interesting.
Thank you so much for having me. I
really
appreciate it.
Good to see you, Michael.
Good to see you too.
Yeah, Liersch, Head of Advice and Planning over at Wells Fargo, joining us here in our Interactive Broker studio. You're listening and watching Bloomberg Businessweek. Carol Massar, Tim Stenovec. This is Bloomberg.